All right, so let's get started. Let me share my screen first. Screen. Okay, I hope you can see my. I hope you can see my screen. Okay, right. So bookkeeping is the science of systematically recording every day-to-day transactions of the company. Bookkeeping is necessary because without bookkeeping, there will be no data to use in order to come up with a fairly presented financial report. So to make it simply, bookkeeping is the starting point of the accounting process. So the account, as you can see on the screen, or also known as the double entry system, is the technique used in bookkeeping accounting transactions. The account is the use of the debit and credit journal entries. So this diagram shows the normal accounting balance of every account in accounting. So here on the debit side, you can see that we have the assets, and example of assets are cash, receivables, inventories, prepayments, and PPEs. And then also another account with a normal debit balance is the expenses. On the credit side, on the other hand, we have liabilities, and the types of liabilities. We have the AP trade, AP non-trade, banks payables, bank loans, and other liabilities. Also, we have the capital, which have under capital, the share capital, and the retained earnings. And if you can see, if you still remember on our previous discussion, that assets is equal to liabilities plus capital. So that is why assets is on the debit side, and on the credit side, on the other hand, is the liabilities and capital. Because if we add these two, we will get the assets. So, right. And how come that expenses and income is also there? If we will also go back on our previous discussion on the income statement part, retained earnings composes of expenses and income, because the result of income less expenses is either net income or net loss, and this net income or net loss are being closed under retained earnings. So since retained earnings is a capital account, its normal balance is credit, and every time that the company resulted to net income, it is under a credit balance. Also, every time the company incurred expenses, it will be deducted from the income. Its normal balance is debit. So I will further explain it on the next part. So, right, this is actually this T account or the double entry system is very technical, and many professionals who are just starting learning accounting, we're always committing mistakes on this one. Why? Simply because we are used on the preconceived idea that when an account increases, it should be reported as debits. And when an account decreases, it should be reported as credits. However, this is absolutely not true and a common error in the accounting profession. So I will show you another another picture here, this one. I hope you can see this one on your screen. The normal accounting balance is the key to make the accounts correct. So when the normal accounting balance is a debit, I will go back on the first illustration here, this one. Normal accounting balance is debit. We have assets and expenses there. So what will happen is that um, every time that account, the assets and the expenses increases, it will be recorded as debit. And when it decreases, it will be recorded as credit, as shown in the illustration. On the other hand, when the normal balance is credit and when the account of these credit balances like liabilities, capital, and income increases, it will be recorded as credit. And when it decreases, it will be recorded as debit. I will show you that on the next illustration. Okay, let's see. Here, this one. Yeah. Okay. So all we have to remember every time that um, we are making journal entries, all we have to remember is that when we record a debit, there must always be a corresponding credit amount and vice versa. Because debits and credits in accounting must always be equal. And this can be checked through trial balance at the end of the accounting period. So trial balance is a way to check if both debit and credit balances transactions are equal at the end of the accounting period. If there is a resulting variance, error must have been committed on the process of recording. So to show you an example on how data entry works, um, let's go over to the following transactions. I will share my screen again, and I hope that we can actually learn from these transactions. So yeah, let's see. I have here a sample transactions for veggie burger patty manufacturing. So the first transaction is that the company bought a bicycle for a cash of 13,000 pesos intended for delivery as a start of this. So the entry would be uh, debit cash, since it is a debit, no, let's see. Credit cash, we have 30,000. Why? Because since cash is an asset account, and here we can see the transaction that a cash is being deducted in order to buy a PPE. So we will put 13,000 cash as a credit since cash was being deducted or a portion of your cash was being used and being expensed out to buy a bicycle. So we put credit cash and debit PPE. Why? Because bicycle can be used by the company for a long period of time. So it is considered as an equipment or a fixed asset. So we debit PPE 13,000. So a sample P account that we will put in a ledger is this. Cash 13,000, and in PPE we have here PPE debit 13,000. All right. Then the next transaction we have, the company paid 576,000 as salary to its employee. Probably this is for the full year. So yeah, the next journal entry would be debit salary expense. So salary is an expenses. So debit 576,000 salary expense, and another one credit cash again. Why? Because cash is being used to pay its salary, to pay salaries to its employees. So credit 576,000. So our P account will look like this one. Yeah, I hope you can see it on your screen. You have cash, credit 576, and we will retain the 13,000 there. This is the ledger. How will we do the ledger? And debit expenses and salaries and expense 576,000. So another transaction. So this is how you do the T account. And the journal entry would look like this one. Okay. So another transaction. The company reported cash sales of 1.846 million pesos and cost of sales 735,150 in the first year operation. Also, there is a fixed utility cost of 12,000 pesos. So this is how we will record it. Debit cash. This is for the sales, 1.846 million, and credit revenue. Revenue is the normal accounting balance of revenue is credit. So since revenue is being increased, we have credit 1.846 revenue. Okay, then the company incurred cost of sales. Cost of sales is an expenses. If we go back to our previous discussion, so cost of sales is an expense. They incurred 735,150 cost of sales. So debit cost of sales 735,150 and credit inventory. Alright, since cost of sales is a deduction to inventory. So here we can see another transaction, utility expense debit 12,000 and 80 non-freight. Why? Because our utility expenses like water bills, electric bills, we incurred it in advance while we paid the billings on the next month after we incurred expenses. So this is still at 80 non-freight accounts payable. So this is how we go with the T account. So we have debit cash 1.846 million representing sales. And then we have a credit sales 1.846 million. And then the next part would be expenses. We have 735,150. This is for the cost of sales. And the 12,000 for the fixed utility cost. That is debit. And credit inventory representing cost of sales also. And AP non-trade, of course, our credit 12,000. So here we can see that every time we record a debit, there is a corresponding credit account. All right. So every time we use cash, there should be a resulting expenses, and every time we gain cash, there must be a corresponding revenue, or it could be a corresponding AP, or every every time we gain cash, there must be a corresponding investment from its owner or capital. So this how we go it. And if we summarize it, we now have a trial balance. Yeah. So how we get this trial balance? Well, of course, let's say for example, we have cash. If we go to the T account of cash, we can see here trial balance cash is 1.2 million pesos. So how we get that? So let me share another screen to you. Let me stop sharing this one first. I will share to you my working paper, how I get that. All right. Okay. We have here, we have here this one. Let me share my screen again. Hopefully it's screen. Yeah. Okay. This one first. Okay. So we can see here that our trial balance results to one 1,257,000. How did I get that? Well, you can see here, if we go to the T account of cash, let's make this one. Let's go get the sum of the total credit and debit balances. Uh-huh. Okay, let's try it. Sum. What's that calculating? Oh, this one is not a number. Okay, again. Let's put this in a number. 13,000. Then we have 576,000. Yeah. we got 589,000, and then we get the 1,846,000, and then get the sum also. Yeah, this is the total debit credit. And cash, since cash is a normal debit balance, less the 1,846 less 589, we got the 1,257. So here, we got this one. And we can also do that for the other accounts, like the PPE, the expenses, sales, inventories, AP non-trade, and then we will get this portion. All right. Now, how did I put this one on a financial statement? Okay, let's do this part. Going to the financial statement, we now have here cash, the total balance of cash, then we have the inventories, then we have the AP non-trade, revenue, cost of sales, salary expenses, utility expenses, and how did I get the loss on write-up of assets? So let's see. For example, the PPE, we have the bicycle, we bought it for 13,000 cash. However, the company decided that instead of using bicycle as a form of their delivery equipment, they decided that on the next year of operation, they will buy a truck, delivery truck. So they, the bicycle is no longer of no use for their future operation. So the company decided to write it off. So the entry would be debit loss on write-off of assets, right? Of asset, 13,000. This is an expense account, so 13,000. And PPE, property, plant, and equipment, property, plant, and equipment, 13,000. All right. So now, how did I organize this one? So we have here a balance sheet account, yeah, 1.2. And then inventories, why is this negative? Because we don't have a debit for inventory. Probably our accountant forget to record that they bought a raw materials first before they create a veggie burger patty. So this is a questionable account, and we will go on further discussion on that, on how to analyze our financial statement. But yeah, let's see first. So there are zero debits for inventory, and instead of having a debit balance, which is supposed to be the normal accounting balance of inventory, we got a credit, so this would be negative. So the result is 521. Then yeah, our total asset is 125 plus negative 735, or 1257 less plus negative 735. We have 521,850. Then we have 18 untrade, since we no longer have other liabilities, so we record 1,812,000. And then retail earnings. How did I get the retail earnings? If we go to our income statement, we have a sales of 1.8 million, less cost of sales of 735, less sales and general and administrative expenses. How did I get that expenses? So we have here salary expense, if you can see, salary expenses plus utility, yeah. So we have 588,000. Then other expenses is of course the loss on write-off of assets, which is the bicycle, 13,000. So we get a 509,850. Since we don't have a recorded capital, which is very, very questionable. So yeah. Since we have no recorded capital, so we just put the retail earnings. And the total capital will be 509. And if we plus 509,850 to 12,000, the result is 521,850. So if you can, if as you can see here, the total liabilities and capital must equal the total assets. So this balance sheet is technically correct when it comes to total. However, the inventories is a little bit questionable, but we will get back on that. And now, after I describe the income statement, we have here the cash flow statement. Here, uh, below the cash flow statement. So we have a resulting net income of 509,850 and adjustment for loss on write-off assets. Why did I add this back? Because 13,000 is actually a non-cash expense. It is a result of write-off only, but no cash transaction. So we will add this back since cash flow statement is all about the cash basis. And we have here decrease or increase in inventory. Of course, we have a decrease in inventory of a negative 735. So we will add this back since there is no cash transaction. And increase in trade and other payable, there is no cash transaction also, so we will add this back. So we have a net cash flow from operating activities of 1,270,000. Then addition from investing activities, we have the PPE, of course, we write it off. So we now have a deduction to property of 13,000. Yeah, this is on the income statement part. And here, we actually deduct the loss on write-off also here. So this is the cash flow from investing activities. Then cash flow from financing, we don't have increase in capital. We also don't have increase in bonds payable. So we don't have cash flow from financing activities. So we will add all this net cash flow from operating, net cash flow from investing, net cash flow from financing. So we will result to 1,257,000 net increase in cash. Plus cash at the beginning of the year, we don't have because this is actually the first year of operation. So we have the 1.257 million cash at the end of the year. And if you can see this 1,257,000 cash would be the same cash in the balance sheet. So that would be our checking. The net cash flow at the end of the year should be the same cash flow that will be reflected in our balance sheet. Now, when it comes to financial analysis, let's go here on the financial analysis part. This is really getting more exciting because here, if you will read my comment here, having a negative balance is unacceptable in the financial statement. In this case, the accountant probably forget to record how much inventories they bought. That is why when they record cost of sales, they deducted it from inventory, which is currently zero at the moment. And when we deduct it, 0 less 735, so of course it will result to negative. And this doesn't make sense because you cannot make a product without a raw material. So there must be a debited inventory first. So this is what we call financial analysis. If there is an abnormal balance in the financial statement, we should check on that. So this must be the adjusted balance in the financial statement. So as you can see, I have a correcting entry here, a debit inventory of 1 million, credit cash 1 million. So how will we go with the trial balance again? So yeah, if you can see here, our unadjusted balance of cash is 1,257,000. But since there is an unrecorded deduction of cash of 1 million and an unrecorded increase in inventory of 1 million. So this will change everything. So the 1,257,000 cash will be less by 1 million. So it will now be 257,000. And our inventories, it was originally negative 735. If you add 1 million, the result will be, let's see, negative 735 plus 1 million inventory. Result is 264,850. So this is the same here. Yeah. So we have now a balance of inventory 64, and then the other balance is still the same way. So if we put this in order, cash 257 plus inventory 264, there's no PPE since we write it off. So the resulting asset is 521,850. And we also have the AP non-trade plus retained earnings because of our net income of 509,850. We've added all together the AP and the capital, we have 521,850. So it's the same with the total asset. And yeah, income statement still the same. All right. And the cash flow will change also. We have net income, same way, 509,850 plus 13,000 right-on assets. And inventory, we have an increase in inventory and we will deduct it because every time that we have an increase in inventory, of course, we buy our raw materials from our supplier. So this increase in inventory must be deducted since it is no longer cash. So from cash it became now inventory, so we will deduct this. And also increase in trade payables. We have an increase in cash on this. So we will add this one because every time that um we have a liability, of course, we got an increase in cash. So yeah, and then deductions of property, plant, and equipment. This is a reduction in our investment. So there's no finance activity, and then the result is if we add 270,000 plus negative 13, so we have 257,000, which is the same way with cash in our balance sheet. So yeah, that's it. So here we can see that um, making financial statement is actually um, very interesting, very analytical, and very easy. You just have to take note of all the transactions. And if we only take note and if only we are being cautious on our bookkeeping and we do it responsibly, we will never get lost in our direction in accounting process. So yeah, so I hope guys you learned from these lectures. It is actually very easy. And after this lecture, we will going to have a unit class on how to make journal entry and financial statements. So the next video will be all about the instructions.